Question 9. Are there other ETFs with similar objectives of TGLR ETF, but lower expense ratios? Yes, there are several ETFs with similar objectives to the TGLR ETF, dividend income and capital appreciation in large-cap companies, but with lower expense ratios. Here's a breakdown to help you compare. Understanding TGLR ETF. Investment objective, seeks capital appreciation and dividend income through investment in high-quality, large-cap U.S. companies. Expense ratio, 0, 95% as of March 8, 2024. Alternative ETFs with lower expense ratios. Here are a few examples of ETFs that share similar objectives with TGLR but have lower expense ratios. Fidelity Dividend ETF for rising rates, FDRR. This ETF focuses on companies with a history of increasing dividends and potentially outperforming in rising interest rate environments. Expense ratio, 0, 29%. Schwab US Large Cap Value ETF, SCHV. This ETF tracks a value index of large cap U.S. companies, aiming for capital appreciation through value investing principles. Expense ratio, 0.03%. Vanguard High Dividend Yield ETF, VYM. This ETF tracks a broad index of high dividend-paying U.S. companies across various sectors. Expense ratio, 0.6%. Important considerations. Expense ratio impact. While a lower expense ratio generally translates to better returns over time, it's not the only factor to consider. Underlying holdings. Compare the specific holdings of each ETF to understand potential sector weightings and company selection strategies. Dividend yields. While all these ETFs aim for dividend income, their actual yields might differ. Research the current dividend yields of each ETF. Past performance. Past performance is not necessarily indicative of future results, but you can compare the historical returns of these ETFs with TGLR. Question 10. Could a combination of individual stocks or other ETFs achieve a similar outcome with potentially lower costs or greater control? Yes, a combination of individual stocks or other ETFs could potentially achieve a similar outcome to the TGLR ETF with potentially lower costs or greater control. Here's a breakdown of the pros and cons of each approach. TGLR ETF. Convenience. Provides instant diversification across a basket of large-cap companies with a focus on dividend income and capital appreciation. Professional management. The sub-advisor actively manages the portfolio, potentially offering expertise in stock selection and portfolio construction. Lower research time. You don't need to spend as much time researching individual companies. Downsides of TGLR ETF. Higher expense ratio. The expense ratio eats into your returns compared to potentially lower cost alternatives. Limited control. You don't have direct control over the specific companies held within the ETF. Passive acceptance of sub-advisor decisions. The ETF's performance relies on the skill of the sub-advisor. Individual stocks. Potentially lower costs. You avoid the expense ratio of the ETF. However, commission fees for buying and selling individual stocks can add up. Greater control. You have complete control over which companies you invest in and the weightings within your portfolio. Potential for higher returns. By carefully selecting high-quality dividend-paying stocks, you could potentially achieve better returns than the TGLR ETF. Downsides of individual stocks. Higher research time. You need to thoroughly research individual companies before investing, including their financial health, dividend history, and future prospects. Risk of concentration. Investing in a limited number of stocks exposes you to greater risk compared to the diversification of an ETF. Active management required. You need to continuously monitor your portfolio and make adjustments as needed. Other ETFs. Broader selection, you can choose from a wide variety of dividend-focused ETFs or large-cap ETFs with potentially lower expense ratios than the TGLR ETF. Diversification benefits. ETFs offer diversification across multiple companies, reducing concentration risk compared to individual stocks. Lower research time. Compared to individual stocks, you still need to research the ETF itself, but not individual companies within it. Downsides of other ETFs. Limited control. You don't have complete control over the specific holdings within the ETF. Less tailored approach. The ETF's investment strategy might not perfectly align with your desired sector weightings or specific stock preferences. Choosing the right approach. The best approach depends on your individual circumstances and investment goals. Here are some factors to consider. Investment knowledge and experience. If you're comfortable researching and managing individual stocks, you might achieve a more customized portfolio. If you prefer a more hands-off approach, ETFs offer diversification and professional management. Risk tolerance. Individual stocks carry a higher risk of underperformance compared to diversified ETFs. Consider your risk tolerance when deciding between the two options. Time commitment. Managing a portfolio of individual stocks requires more research and active management than simply investing in an ETF. Question 11. What are the pros and cons of this TGLR ETF compared to similar options? The TGLR ETF offers income and capital appreciation through investment in large-cap U.S. companies, but it has both advantages and disadvantages compared to similar ETFs. Here's a breakdown to help you decide if TGLR is a good fit for your portfolio. Pros of TGLR ETF. Focus on high-quality dividend payers, targets established, financially sound large-cap companies with a history of paying dividends, potentially offering a reliable income stream. Actively managed. The sub-advisor, Laffer Tengler Investments, actively manages the portfolio, aiming to select the best opportunities within the large-cap and dividend-paying universe. This can be appealing to investors who prefer professional management. Convenience and diversification, provides instant exposure to a basket of companies, reducing concentration risk compared to individual stock picking. Cons of TGLR ETF. Higher expense ratio, 0.95% as of March 8, 2024. This fee eats into your returns compared to passively managed ETFs that track broad market indexes and typically have lower expense ratios. Limited transparency. The specific holdings selection process and criteria employed by the sub-advisor might not be fully transparent to investors. Concentration risk. While diversified across large-cap companies, the TGLR ETF might still have a concentration in certain sectors, potentially impacting performance if those sectors underperform. Performance uncertainty. The ETF's reliance on the sub-advisor's skill and market timing can lead to unpredictable performance compared to passively managed ETFs that track broad market indexes. Comparison with similar ETFs. Here's how TGLR stacks up against some alternatives. Lower expense ratio ETFs. These ETFs, like Schwab US Large Cap Value ETF, SCHV, or Vanguard High Dividend Yield ETF, VYM, offer broader diversification and potentially lower fees. However, they lack the active management component of TGLR. Broad market ETFs. These ETFs, like SPDR SP500 ETF, SPY, offer exposure to the entire SP500 index, providing significant diversification but potentially lower and less predictable dividend yields compared to TGLR. Sector-specific dividend ETFs. These ETFs, like SPDR Real Estate Sector ETF, XRE, or Vanguard Energy ETF, VDE, focus on specific sectors known for high dividend yields. They offer concentrated exposure and potentially higher yields, but also higher risk if the chosen sector underperforms. Question 12. What are the potential benefits and drawbacks of investing in TGLR ETF compared to individual stocks within the same sector? Here's a breakdown of the potential benefits and drawbacks of investing in the TGLR ETF compared to individual stocks within the same sector. TGLR ETF. Benefits. Diversification, owns a basket of companies within the sector, reducing concentration risk compared to holding just a few individual stocks. Convenience, easier to buy and sell, compared to managing a portfolio of individual stocks. Lower transaction costs, typically lower expense ratio compared to commission fees associated with buying and selling multiple individual stocks. Professional management, the sub-advisor actively manages the portfolio, potentially selecting the best opportunities within the sector. Drawbacks. Higher expense ratio, compared to potentially buying individual stocks without commission fees. Limited control, you don't have control over the specific companies held within the ETF and their weightings. Potentially lower returns, the ETF's performance is tied to the sub-advisor's skill and may not outperform well-selected individual stocks. Less tailored approach, the ETF sector allocation might not perfectly align with your desired company preferences within that sector. Individual stocks. Benefits. Potentially higher returns. By carefully selecting high-quality stocks, you could outperform the TGLR ETF, especially if the sector outperforms the broader market. Greater control. You have complete control over which companies you invest in and their weightings within your portfolio. Lower overall costs, potentially lower costs compared to the TGLR ETF's expense ratio, especially if you avoid frequent trading commissions. Potential for deeper research, you can conduct in-depth research on specific companies to identify undervalued opportunities within the sector. Drawbacks. Higher research time, requires significant time and effort to research individual companies, analyze their financials, and monitor their performance. Concentration risk, investing in a limited number of stocks exposes you to greater risk compared to the diversification of an ETF. Active management required, you need to continuously monitor your portfolio, make adjustments as needed, and potentially react to market fluctuations. Risk of emotional investing, making investment decisions based on emotions rather than a sound research process can lead to poor choices. Question 13. Would adding TGLR ETF improve the portfolio's diversification or potentially increase concentration risk? No, the TGLR ETF's exposure likely wouldn't be entirely unique and could be replicated, at least approximately, through a combination of other holdings. Here's why. Limited uniqueness due to sector focus. The TGLR ETF focuses on large-cap companies within a specific sector, likely a mix of sectors based on available information. This sector allocation isn't unique. Investors can achieve similar exposure through other means. Replication strategies. Sector ETFs. Several ETFs target specific sectors like technology, financials, or healthcare. By choosing an ETF that aligns with the sector focus of TGLR, you can achieve similar exposure. Large-cap stock selection. Researching and selecting individual large-cap dividend-paying stocks within the desired sector can replicate TGLR's core holdings to a certain extent. However, TGLR offers some advantages over these alternatives. Convenience. The TGLR ETF provides instant diversification and eliminates the need to research and select individual stocks. Professional management. The sub-advisor's active management might add value through their expertise in selecting companies within the sector. Uniqueness might lie in sub-advisor's approach. While the specific holdings aren't unique, the TGLR ETF's potential uniqueness might stem from the sub-advisor's, Laffer-Tengler investment philosophy and selection criteria. Their approach to choosing high-quality dividend-paying companies within the sector could differ from the holdings of a passively managed sector ETF. Factors affecting replication accuracy. Incomplete transparency. Since the TGLR ETF specific holding weights and selection criteria might not be fully transparent, perfectly replicating its holdings through individual stocks or other ETFs might be difficult. Active management versus passive management. Replicating the TGLR ETF through a passively managed sector ETF might not capture the nuances of the sub-advisor's active selection process. Alright everyone, that's all the time we have for the TGLR ETF today. So, to wrap it up, the TGLR ETF offers a convenient way to access dividend-paying large-cap companies, and potentially benefit from professional management. But remember, it comes with an expense ratio and limited control over holdings. Consider your investment goals, risk tolerance, and whether you prefer a hands-off or hands-on approach. You might be able to replicate similar exposure with other ETFs or individual stocks, but it requires more research and active management. No matter what path you choose, do your research and make sure it aligns with your overall investment strategy. If you have any questions about the TGLR ETF or any other ETFs, leave a comment below. We're always happy to chat ETFs with you. Don't forget to like this video and subscribe to the channel for more in-depth ETF explorations. Thanks for joining us, and happy investing!